The second topic covered in Chapter 7 is the segment margin income statement. Segments used widely by the business management in different situations, and you can define the segments by locations, by subsidiaries, by product or service lines, or by departments. It doesn't matter how the company define the segments, but when they prepare the segment performance reports, especially internally, we prefer to use the variable costing format. This is the same reason as we used for evaluating the overall company performance, because the variable income statement can provide the management with a direct idea how each of the segments perform with their related revenues and costs can be controlled by the segment itself. So the key structure for the segment income statement compared to the company-wide, we have a further breakdown for the fixed expense into the traceable fixed expense and the common fixed expense. So when you read the ebook from the smart book or tracking, go over the concepts. So make sure you truly understand the traceable and the common. So what traceable means and what common means, and you can identify different examples in different situations. Traceable fixed expense means the fixed expense can be attributable or responsible by the segment managers. That's directly related to the operation of the segments. So for example, if I'm operating the sales department, then the fixed portion of the salary of the sales employees or the depreciation of the office equipment and other fixed expense can be controlled or responsible by the sales manager. That's traceable fixed expense. But if you're looking for the company-wide, for example, the depreciation of the company building, even my office is located in the building, I may share a portion of the overall depreciation or the utility expenses. But those are the common fixed expense because the overall level of the expense cannot be altered or changed by the department or segment managers. So in that case, we break it down like the depreciation or utility expenses or other expenses between the traceable portion and the common portion. So each segment manager is only responsible for the fixed expense can be directly traced to their segments. So when you prepare the income statement, for example, we have two segments in, I believe this should be number three of the homework. So when we prepare this income statement for the segments, so you can see the two segments, they have their relative sales revenue breakdown and the variable expense, their variable, like if it's for manufacture, they have their variable manufacture cost and the variable selling and admin expenses. So they got their contribution margin. With the contribution margin is the same contribution margin we introduced in Chapter 6. Then when we deduct the fixed expense, the first one we deduct the traceable fixed expense to that segment, means the portion they can directly control. We got a margin, be careful, segment margin. So means like the contribution margin earned or the income margin or the income earned by the segment before deducting the common fixed expense. So the segment margin will be the line item you use to evaluate the segment performance internally. And that will be totaled as the segment margin for the total company, like the entire company, but doesn't really make sense. The one we focus on at this line is the segment margin for each of the segment. So when you evaluate their performance, we all like the segment margin ratios. So we can divide by their revenue to get a feeling for which segment is doing better, okay, like in relative to each other. So segment margin ratio, we divide by their relative revenues. For the entire company, then we deduct the total common fixed expense, because this is kind of related to the overall company-wide operations. So you deduct it under the total company column before we get the net operating income for the entire company. So if you couldn't really reconcile between the total company net income with the addition of the two segment margin, because there's still difference between, the difference between the common fixed expense. But again, the segment margin is we use for internal management to evaluate the segment performance. This is especially critical when we try to decide, or if when we have limited resources, we may want to close or drop some of the segments, like product lines or the stores. So how you can rank, or how you rank the performance correctly, so accurately before we make the decision. Or if you want to open more locations and open more product lines, how we rank them, right? So we can pick the top, like the top choices. So rather than using the full absorption, or also break down the common fixed expense, we would rather stop at the segment margin, so you can have a accurate and a reasonable performance. Okay, so that's kind of the focus of the segment margin income statement for internal evaluations.